Keeping your money in the bank feels like the ultimate financial safety net. But the problem is, treating a savings account like a vault exposes you to three silent risks that quietly drain your wealth. I'll show you exactly how much you're losing shortly. Most of us are wired to look at our bank balance and feel relief when the number stays exactly the same. If you deposit $10,000 today, you expect to see $10,000 tomorrow. That visual stability feels incredibly responsible. It feels like you're protecting your hard-earned cash from the chaos of the outside world. To believe a bank account is completely safe, you have to assume that a dollar today buys the exact same amount of groceries 10 years from now. You have to assume the numbers on your screen represent actual, unmoving purchasing power. Except they don't. We need to run a 10-year simulation to see what actually happens to $10,000 when you leave it parked in the bank versus putting it to work. Let's look at the first path, which is the high-yield savings account. We will be generous and assume you find a bank paying a consistent 4% interest over the next decade. You deposit your $10,000 and do not touch it. After 10 years of earning that 4%, your balance grows to roughly $14,800. On paper, you made a profit of $4,800 without lifting a finger. You feel pretty good about it until you factor in inflation, which historically averages about 3% a year. Let's do the real math here. Your 4% interest minus 3% inflation means your real return is just 1% a year. After a decade, your $10,000 hasn't actually grown to $14,800 in true spending power. In terms of what that money can actually buy you in the real world, your balance is worth about $11,046. That loss in purchasing power isn't abstract. It is the difference between affording a full grocery cart or having to quietly put items back on the shelf. 10 years of waiting and you made about $1,000 in real value. That extra $1,000 doesn't change your life. It barely covers a minor car repair. Now you might be thinking, at least I didn't lose any of my original $10,000. But you did lose something far more valuable than nominal dollars. While your money sat seemingly safe, the cost of living compounded against you, making your future self work harder just to maintain the exact same lifestyle. Let's look at the second path in our simulation, which is investing that same $10,000. When people hear the market, they usually think of a loud casino where money vanishes overnight. We're not talking about day trading volatile tech stocks or chasing internet trends. We're talking about broad, diversified investing, where you own small pieces of the largest, most profitable companies on Earth. Historically, the broader stock market has returned an average of about 10% per year before inflation. If you invest your 10 grand and let it sit for 10 years at that 10% return, your balance grows to roughly $25,937. This assumes consistent investing, holding a broad index fund like the S&P 500, and not panic selling during inevitable market downturns. Let's run the exact same reality check and subtract our 3% inflation penalty. Your 10% nominal return drops to a solid 7% real return. After 10 years, in actual purchasing power, your $10,000 has grown to $19,671. That nearly $10,000 difference isn't just numbers on a screen. It is a down payment, a buffer against burnout, or 6 months of living expenses fully covered. Let's put those two reality-checked numbers side by side so we can see the full picture. The bank gave you $11,046 in spending power, while the market gave you $19,671. By choosing the safe option, you effectively paid an invisible fee of over $8,600. That fee doesn't disappear. It compounds against you every single day you stay entirely in cash. But there is a specific moment in year 3 of this simulation where the investor almost always regrets their choice. I'll explain exactly why that happens and how to survive it in a minute. First, we need to talk about what that $8,000 gap actually means for your daily life. Money isn't just paper or digital ones and zeros. It is stored energy and future freedom. When your money doesn't grow fast enough to outpace the cost of living, you have to make up the difference with your own physical labor. You end up trading more of your limited time on Earth just to afford the same basic necessities. The person who left their money in the bank has significantly less job flexibility at the end of the decade. If their boss becomes toxic or their industry shifts, they cannot walk away because their safety net is slowly deflating. The investor, on the other hand, is slowly building leverage. That extra spending power buys them sleep, mobility, and the option to take a calculated career risk without putting their family in jeopardy. Now you might be thinking, what if the market crashes the day after I invest my $10,000? That is a mathematically valid fear, and historically, a 20% drop happens every few years. If your $10,000 drops to $8,000 in month 2, it feels terrible, but the math tells a very different story over a decade. Even if you invested right before the 2008 financial crisis, which was one of the worst times in modern history, your money still fully recovered and grew significantly over the next 10 years. The extended timeline is the ultimate risk reducer. Remember those 3 silent risks I mentioned at the very beginning of this simulation? They are inflation, lost opportunity cost, and the illusion of absolute safety. And that moment in year 3 where the investor starts to panic? It's the completely normal yet terrifying inevitable market correction. In year 3 of our simulation, the market might suddenly drop 15%, temporarily dragging the investor's balance below the saver's. The saver feels validated and smug, while the investor feels foolish and stressed. But the investor who understands the math knows they don't actually lose a single dollar unless they log in and hit the sell button. By year 5, the subsequent market recovery usually pushes the investor so far ahead that the saver never catches up again. The real risk in life isn't volatility. Volatility is just the emotional fee you pay for long-term growth. The real risk is certainty, specifically the absolute mathematical certainty that cash will slowly lose its value over time. Once you accept that keeping all your money in the bank guarantees a loss in purchasing power, your definition of what is safe completely changes. Investing is no longer an optional gamble. It becomes a required defense mechanism. Let's look at how this plays out if we extend our simulation from 10 years to 20 years, because the math gets even more unforgiving. In the bank, at a 1% real return, your original $10,000 becomes roughly $12,200 in spending power after 2 full decades. You sacrificed 20 years of compound interest for a mere $2,000 of actual value. In the market, at a 7% real return, that exact same $10,000 becomes over $38,600 in actual purchasing power. You didn't add another dime, yet your money almost quadrupled in real utility. That $26,000 difference isn't a luxury vacation. It is the difference between retiring on your own terms or being forced to work 5 extra years. But to get there, you need a specific system that removes your emotions from the equation entirely. I'll break down exactly how to structure that system before we finish. We need to address taxes first because the math actually gets worse for the person hoarding cash in the bank. When you earn interest in a high-yield savings account, you owe ordinary income tax on every dollar of that interest every single year.
If you are in a standard 22% tax bracket, your 4% bank interest drops to about 3.1% after taxes are paid. Subtract our 3% inflation, and your real return is virtually zero. That 0% return isn't just standing still. It is a decade of financial stagnation, while the rest of the world quietly moves forward without you. When you invest in the broader market, your money grows tax-deferred. You do not pay taxes on the growth until you actually sell the investment, years or decades later. And when you finally do sell, long-term capital gains tax rates are typically much lower than ordinary income tax rates. The entire tax code is literally designed to reward investors and penalize aggressive savers. By keeping all your long-term money in cash, you are swimming against the current of both inflation and the IRS simultaneously. That is an exhausting, inefficient way to manage your financial life. Now, I am not telling you to abandon cash completely or close your checking account tomorrow. Cash has a very specific, structural purpose in your life. It buys you immediate liquidity and short-term peace of mind. If you need a new roof next year, or you are saving for a wedding in 18 months, Every cent of that money belongs in the bank. You never expose short-term money to long-term market volatility. But any dollar that you do not plan to spend in the next 5 to 7 years has no business sitting in a standard savings account. The mathematical cost of that safety is simply too high to justify. Let's look at the mechanics of actually getting started, because jumping from a familiar savings account to the stock market can feel paralyzing. You don't need a finance degree to do this right. You just need a mechanical, unemotional process. The solution is not to drain your bank account and dump everything into the market on a Tuesday morning. You still need an emergency fund sitting in cash, usually 3 to 6 months of basic, unavoidable living expenses. That cash is your absolute insurance policy, not your wealth builder. Once your insurance policy is fully funded, every single dollar beyond that line needs a specific job description. Start small. Take just $50 a week and set it to automatically transfer from your checking account into a broad, low-cost index fund. You won't drastically miss the $50, but you will start building the mental muscle of being an investor. You will start getting used to seeing your balance fluctuate daily without feeling the urge to panic. Once you are comfortable with the basic mechanics, you scale it up efficiently. You move to investing $500 a month, or a fixed percentage of every paycheck, before you ever have a chance to spend it. This process requires simple discipline, not blind optimism. You aren't trying to time the market, read charts, or pick the perfect winning stock. You are simply buying a microscopic slice of the global economy on a strict, unbreakable schedule. That system, the automated, emotionless transfer of funds, is exactly how you survive the volatility and the Year 3 crash I mentioned earlier. When the process runs automatically in the background, you don't have to rely on willpower or try to predict the evening news. You just step back and let the math do the heavy lifting for you. The math doesn't care about sensational headlines, temporary panic, or the fear of missing out. It only cares about 3 specific inputs: time, rate of return, and consistency. When you align your daily financial habits with those 3 variables, building wealth stops being a mystery and becomes a highly predictable outcome. Let's circle back to our original 10-year simulation one more time to permanently solidify the reality of this choice. The careful saver ended up with $11,046 in real, usable purchasing power. The investor ended up with $19,671. The saver endured 0 emotional volatility, but achieved absolutely 0 meaningful progress in their life. The investor endured several scary market drops, but gained nearly $9,000 in real, life-changing value. The investor didn't win because they were somehow smarter or because they magically picked the perfect time to start. They won because they understood the vital difference between nominal numbers on a screen and real, physical purchasing power. They accepted the cold reality that risk in life is completely unavoidable. You either take the visible, loud risk of market volatility, or you take the invisible, silent risk of inflation. One risk actively builds your wealth over time. The other quietly, systematically consumes it. When you log in and look at your bank balance tomorrow morning, ask yourself what that number actually represents. Is it an efficient tool that is actively working for you, or is it a block of ice slowly melting in the sun? Keeping your money in the bank feels like the ultimate financial safety net, but true safety doesn't come from hiding your money in a vault. It comes from mathematically ensuring your money outpaces the cost of your life. Which risk are you going to choose? If you like looking at money without the myths, stick around.